Wait, what? I can do that? This is Eric Bell with Wait, what? Financial matters that matter for business and the people that own them. If you missed last week's episode with Noelle Nitz and her role as a fractional CFO, that's one you'll definitely want to circle back to and listen. Welcome to this episode of Wait, what? Financial matters that matter. I'm fortunate today to have Cary Potter with me, who is founder and managing director of Deal Valuation, LLC. Cary has about 20 years in the valuation business, but I'm going to let Cary tell you a little bit more about his background and what he's done in the past.
Hi, Eric. Thank you for having me on your show. So about 25 years ago, I got an opportunity to interview with a small firm, about 4 or 5 people, and was thrown an income statement and balance sheet and asked the question, what's the value of the company? You know, from school, you learn things like book value, PE ratios, other things like that. I threw some of those jargons, terms back out and thought for sure that there's no way I got this job. I was called back the next day and said that the girl before me cried because of the pressure that the interviewer put on you and got the job. So to the extent that that started my career in valuation, I was lucky enough to have the basis behind that as an accountant for Pacific Mutual, which is now Pacific Life. So taking the accounting side of things and moving it into a valuation realm was easier for me and created a great opportunity to help people understand where cash flows come from. From there, I had the opportunity to work with KPMG for about 10 years and really refine my skill set, work with large players. I did valuation work for companies like SurveyMonkey, Facebook, Ancestry.com, from a couple of private equity clients that we have. That experience has, allowed me to understand really what the value drivers are for companies and also how to help people understand how to move their companies up the right side of the value curve. Accordingly, I took that concept and didn't really want the partner life of a big 4 accounting firm and decided to start my own firm. We are currently looking at really private equity and family office clients, mostly companies that have raised 10 million or more, helping them understand from mostly a financial reporting and tax compliance aspect, really what the value of their company is or the investments that they've made in the past.
Okay. Wow. That's a lot. Like I said, 20 years worth of experience. I want to ask you, how would you characterize the current valuation environment right now?
It's interesting. It's very dynamic with some irrational exuberance, a term that was used quite a while ago. And also a term I actually saw in a deck produced by a large investment banking firm as far as how to consider future exits for the value of a company. They literally outlined a range of multiples and said that an irrational, exuberant buyer would pay this much for it. I think the quote there is really that, or the idea there is that there are companies willing to pay above average multiples for companies if it fits the right need and fits the right segment of their company or their, industry.
Is there any specific industry right now that's hot?
To the extent that it's transitioned and it's kind of at a plateau at this point, it's interesting. Dining has really ramped up. Any kind of food source, any kind of gig economy company, those are the ones that are, I'll say, at the peak and maybe even on the backside. But those are the ones that I've seen most recently where multiples, that frankly, in some cases didn't make sense, came about from a transaction. The price of stocks relative to bond movements, and there's a number of people that have been, showing different relationships between those two, I think shows the tension. And you'll see, stock prices go up a little bit, then bond prices go up at the same time. Usually they're inversely related because the yield on the bond versus the stock. So to the extent that that tension is there, between that and some of my conversations with the family offices and private equity firms about what's coming across their desk, either the multiples being requested are so high it just doesn't make sense, or they're just not even pretty enough to be at the show. That kind of tension, again, it tells me that we're at a very interesting point in, the valuation, environment.
So help me understand. Let's say I have a plumbing store. We're doing $10 million a year in revenue, and I want to keep it real simple. Mm-hmm. How do you go about taking care of that guy? Or what's some of the first steps in terms of looking at his business and deciding if, what the value of his business is? Let's say for a buy-sell agreement. Let's say for a sale of the business. Let's say for key man insurance. Just looking at the whole picture in terms of valuation. I know there's so many things that you can evaluate. Mm-hmm. Looking at those kind of aspects, how would you do that for a plumbing business, for example, using an owner?
Sure. To the extent that we come in and we help We ask some questions right off the top. What segment of the market are you addressing? How are you getting your customers? What's your customer retention? How does your historical results correlate with expectations in the future? The value of any company is the present value of all future cash flows. It's kind of a finance 101 term. From that, we look at history and we say, okay, where do we expect these guys to go? How would they fit into a synergistic buyer? Is that opportunity available? Is someone else can just come in and take over the business because there's really no synergistic acquirers available? Do the relationships they have, are they so key to the prospects and the opportunity that a key owner leaving would devastate the company? How are they going to handle that? What plans are in place to address those needs? So after asking some questions, it really starts to send you down rabbit holes as far as where the real either value is or where the real risk is. One of the things that I kind of base all of my conversations on is a little template that I came up with that basically talks about the three drivers of value: cash flow, risk, and growth. And I call it the value equation. You can see it on my webpage at dealvaluation.us. To the extent that cash flow over risk minus growth is an old bond formula, it also is a great way to talk about and frame conversations and value. So how steady is our cash flow? Where is it coming from? What are our future expectations? What are the long-term growth prospects? Do we have people moving into the area that use their service? Less people that use their service? Is there some kind of growth capability from either an internet portal or version or other things that can help drive, above inflation level growth long-term? And what's the risk associated with both of those relative to other investments? At the end of the day, all investments are really an alternative to a different investment, right? I'm going to either invest in this over here or I'm going to invest in that over there. Well, we can get information about investments either that have been sold or people that have made investments in companies or public companies in some cases. And we can take that risk profile and then look at the subject company and say, relative to these investments, where does our risk profile sit? Are we extremely more risky or less risky?
If I kind of compare it to real estate, it's like looking at the comps in that particular neighborhood.
Absolutely.
Okay.
And I think it's one of the things that are most difficult to do in valuation. Valuation is, in some regards, an art and a science, right? The science, the math really isn't that complicated at the highest levels. A level of earnings, a level of revenue, a multiple applied to it. There you go. There's a value, right? There's obviously a lot more to that. But the comparables, right? Really, what is comparable? Mm-hmm. What is the customer base? What is the real driver to the value of the company? Is it the technology? Is it the people? Is it the relationships they have? Those are the type of things that I want to make sure that when I'm looking at comps, I'm comparing the right animals.
Okay. So would that valuation be used also for a buy-sell agreement, or would that be a different valuation? Or I guess what I'm asking, does one valuation cover all purposes?
No, absolutely not. Most of my time is spent in financial reporting and tax reporting world. There's definitions: fair market value, fair value. It all has to do with a willing buyer, willing seller. Everybody's got adequate knowledge. It's a financial buyer view, right? There's no synergies to the table, those type of things. When we look at comparable companies, we obviously consider whether they were being acquired by a highly synergistic, acquirer. One of my past clients or recent clients was Shipped. It was bought by Target. Obviously, there was huge synergies to the ability to take a delivery service company and integrate it with a company like Target. That type of synergy obviously is not appropriate to apply to a buy-sell agreement because really you don't have that benefit on the backside. And that multiple is different than a financial buyer who comes in and just continues to run the company at its current level.
Okay, so all valuations are not the same.
No, absolutely not. And then further down the road, if you're doing estate and gift tax or you're doing options to executives,
Mm-hmm.
they have a non-marketable interest in a minority company. So we'll take discounts on top of some of the value conclusions that we come up with to address those needs as well.
There's a lot of interesting stuff out there in the media. What are some of the interesting headlines relative to your profession right now?
The articles I like to read really talk about the products out there, the public stocks, the PE investments, the VC funds, which everybody seems to be starting. There's, in the past, a mutual fund to me was, a certain type of instrument. Well, it seems like the PEs are now more like mutual funds than anything else. The venture capitals kind of stepped into where the PEs used to play, and the family offices are now stepping into where the VCs and some of the PEs are even playing.
Now, what makes you say that?
Well, just from the size of investments that they're making, the sophistication internally, their goals long term, they're seeing the value that private equity brings to the table. Having a niche within a certain industry, being able to collect those investments, use synergies within the investments and the teams available to them to really grow them above average, right? And that's the key. If I can get a return that's above average, now I'm doing something different. And the PEs have, really kind of locked into, in the past, how do we re-leverage these companies, right? How do we financially engineer them, they would say. That's gone, right? That financial engineering is pretty much played out as much as you can do it, especially with the cheap cost of debt. To the extent that now you need to really, reorganize a company or organize a company in such a way that it can grow differentially. Again, cash flow, maybe we can change that in some different way that other people weren't thinking about. Risk, maybe we can lower the risk by diversifying or doing something else. Or maybe we can address a long-term growth pattern that maybe other people aren't seeing.
When I think about, to me, small to medium-sized businesses, and by definition, I'm looking at a $10 million to, let's say, $100 million business, family-owned, privately held. What are some of the, mom and dad want to sell it, they're going to sell it to a third party. What are some of the challenges that you see in terms, everybody thinks their business is worth more than it is. So what are some of the challenges that you see in terms of helping them evaluate that business to be sold? They may have a buyer, and of course the buyer wants to pay less, they want more. How does evaluation play into all that?
Absolutely. So to the extent that the valuation story, I think is key. If you can tell a story about how your past is leading to a better future, a more synergistic future, a larger set of cash flows that are available to the next owner because maybe they have availability of capital or other things that the current owners don't, you're more likely to hit on the sweet spots of potential investors and potential buyers. So to the extent that I watch articles about supply and demand within the industry, small, but the growing voice of audit teams and SEC reviews, it's interesting, some of those articles and what they're saying about certain industries and certain companies. And if you can start to read between the lines, you can help formulate your story of the valuation story around your company such that it mitigates the risk associated or accentuates the cash flow opportunities available.
It's funny, you were talking about how a lot of times a business is tied to an individual because they start the company, they're kind of the face of the business. I've seen some buyouts where that person stays involved for a couple years. Does that play into the valuation, or how does that work?
It absolutely does. And to the extent that a buyer wants to parachute out quickly, in certain companies, it could be totally available to him because of the infrastructure and the team that he's built. If he doesn't have that team available and his relationships, his drive, his command of the industry is really what's driving it, then he may have to be locked up for a couple of years. And it's more likely you're going to end up with contingent consideration, earnouts as part of your consideration for the deal, because the buyer doesn't want to take all the risk up front. He wants to spread that risk out over time to help transition those relationships, that knowledge over to the new team or over to a team. So one of the big things we talk about is that infrastructure, that ability to replace yourself, especially in those smaller companies. It's interesting because there's a dynamic there that also has to do with personalities and especially with content and social media, how much that plays into it. I have a family office in New York that I work with that uses personalities, that really invest in personalities and invest in people because they see the impact of their social play, their newsworthiness, right? Their ability to generate content, how that plays onto the company's value. So even the small shops nowadays are getting that. My son goes to a mixed martial arts studio and his social media output is pretty robust. And to the extent that that's the way he drives traffic, you see that now in every walk of life. And so to the extent that people have that following, is it their personal following or is it the corporate following? Can we transition to the corporate following so it's not so much about me, it's more about the corporation and the products?
You were talking about customers and customer retention before. I had a client who had a concentrated customer situation and he was going to sell or wanted to sell. But when they looked at it, they said, you need to have more clients because if you lose that one client, business is
devastating.
Gone.
Yes.
And that business was also tied to him. So he had a couple double whammy there. Customer diversification is a key in terms of selling a business too.
Absolutely. It's one of the questions we drill down on pretty heavily. It's interesting as part of my history with KPMG, like I mentioned, for 10 years, a lot of what we did was purchase price allocation. So we go into a Fortune 500 company that made a recent acquisition. For accounting purposes, they have to break up that value, that purchase price among the different assets, intangible assets, tangible assets. Some of the intangibles that came out are customer relationships, trade names, technology. The interesting one to me was customers and how little was really known about the customer history. Catalog companies, for instance, they understand their customer base. They know if I send out so many catalogs, I'll have this hit ratio, based on this group. And they'll even, break up those groups into, high-level buyers, low-level buyers, and potential opportunities. It's amazing how many companies don't understand that aspect of things. How much did it cost you to get those customers? What's your customer acquisition cost? How many customers churn every year? For instance, I worked with a dentist office, 50 location dentist office. They had a 90% basically loss ratio the first year. It was an all cash business. It was addressing the Hispanic market. So there was some understanding that, these people came in when their teeth were hurting and they just needed, that
some
cure.
relief. Yeah.
Exactly.
Relief. Yeah.
But to the extent that, that 90% kind of loss or lack of retention could be changed even by 10%, you can imagine the benefit to the company long term. And to the extent that what's interesting is the last 10% actually had a 95% retention ratio after that, they were obviously doing something right. It's how do you transition that? How do we, and I talk about adoption or disrupt, that cycle or that customer relationship experience so that you can retain a little bit more.
What are some of the questions that clients are asking you right now or are talking about? What are things that are on the forefront of their mind?
Sure. So to the extent that we address, again, family offices, private equity, companies with complex capital structures, it's what's the real internal rate of return of my Class C preferred or my Class F preferred that I just purchased? Because preferred stocks, especially, non-participating and participating, have some bond-like components and some equity-like components. And so to the extent that you look at that and understand really what the discount rate, the required rate of return for that class and within the stack, right? Am I the first person that gets paid on a liquidation? Is that just the return of my investment? Do I have any dividend that kind of builds up in between there? When do I get paid for my equity? I have an interesting graphic that's just part of our exhibits that shows, okay, yes, you get the liquidation preference up front from 0 to, let's say, 10 million. But you know what? You're not going to get equity upside until you hit 150 million. So there's a big gap in between there. And if the company is at a point where it's growing very rapidly, the risk of both sides of that, equation are pretty high. Mm-hmm. So, yes, you'll retain the 10, but maybe the upside, is a 40, 50% kind of, discount rate or required rate of return level. And, it's more risk than maybe they wanted to take on. They just didn't realize it. So, what's the true internal rate of return on the exit strategy, right? Because most investors buy companies for some type of exit strategy or long-term dividend, right? And so to the extent that you look at private equity and family office, it's commonly get in, grow the company, and get out. So when can we sell? At what multiple do you think we would sell at? What's the waterfall look like from that sale? And what ends up in my pocket? And then basically, what's the discount rate associated with that based on the purchase price I just made? That kind of correlation is a big part of our conversations, as well as kind of, should we sell now for the smaller companies or the companies that we're working with the management teams on? Should we change our prospect to, a 3-year outlook from a 1-year outlook? Because the technology is really hot, but we think we can build a customer base around the technology and exponentially grow the value over the next couple of years. Those are really the questions that are coming across my desk most often.
I know a lot of family-owned businesses and small businesses, their employees are like family to them. So that kind of buy and sell, I'm going to buy your business, but I'm going to go ahead and dump it a couple years down the road. That's not a good thing for a lot of the small business owners that are trying to sell. They're looking at someone who's going to buy the business and sustain it, if anything, make it bigger and grow, and hopefully retain those employees that they have there. Is that common, or is that becoming more uncommon in what you're seeing anyway?
It really depends on the industry. I have a technology company that just sold to a major public, and they have a very family feeling. They've been doing this for 15 years. They were way ahead of the game as far as the technology is concerned. Technology has finally caught up to them and become a critical part of the larger play. Mm-hmm. So now the larger players are like, ooh, yeah, we really need this aspect. And it's not very likely they were going to retain the employees. They were going to pull the technology in, which is pretty well developed, and pretty much, put it into their infrastructure as far as future development, sales, operations, especially finance, right? So if that's a concern, if that's, one of the key drivers, which is a great thing to have, I want my employees to have a future. You can build and start to think about that early enough on so that it's kind of ingrained into the company, right? That the growth mechanisms are internally. The knowledge, the talent base really adds to the long-term prospects and therefore the value of the company. Why would you want to give it up at that point?
It seems like you're a collaborator with business brokers and merger and acquisition people. Is that correct? Or do you work with them a lot?
I do in some regards. There's usually two realms. One is the company's not ready yet. Mm-hmm. And so, let's turn it over to Cary and have his team. And I work in two different realms. I work with the company Deal Valuation that I founded, as well as a company P4 Collective, which is a group of C-suite level and individuals in sales, marketing, operations, finance, HR. And we go in as a team and look at these companies and say, look, here are the lowest hanging fruit, highest risk items that can really change the value of your company over the next couple of years. Let's help you implement that, or just give you the ideas and have you implement them. That really helps business brokers because they retain the relationship, sell the company in the future, and know that, they're going to be on a good track to actually, make more money from the transaction. The other aspect is, to your point, companies people think their own companies are worth maybe more than they probably could sell at. To come in as a third party and kind of give them some guidelines as far as really what the range of potential sale values are is sometimes eye-opening, and it takes the pressure off the business broker to sell at a price that's just unreasonable or even go to market at a price that's unreasonable.
I want to talk about your process, Cary. Let's say I got that plumbing company, back to the plumbing company. I think it's worth $20 million. You gave me a valuation. It's really only worth 15. And now I do want to sell. What's the process in terms of engaging you and step by step? What do I just call you and you come out and do a valuation? I'm trying to get time frames around evaluation. How long does it take? I guess that depends on the company, but I kind of want to leave that to you in terms of how you go, what your process is.
It's similar for almost all of our companies. So our process includes collecting information, doing a site visit, coming up with some preliminary indications and having a phone call about some of the assumptions and inputs that we're looking at, and then delivering some draft exhibits and then a report later. The process usually takes 3 to 4 weeks, and it's pretty common for all the companies we work for. The 3 to 4 weeks really incorporates management, pulling the information together, answering some of the tougher questions that we have, really, coordinating with the different groups that we want to speak to internally in the companies. That process obviously can be expedited and has commonly been expedited when necessary. We start with an information flow that comes out with a proposal, and that way right off the bat, what you're getting into, how much it's going to cost, what the timetables are, what information we're looking at to get kicked off. And then from there, we start to dig into what we found from the first layer of information. After we get to a point where we believe we understand the company, the industry, kind of the underlying assumptions and inputs, then we go back to management and we say, okay, here's what we're seeing. Help us make sure that we're not missing something. We're not overstating or understating some aspect of the company. And then we talk about preliminary indications. Again, roll out some draft exhibits for them to share and socialize within the groups that need to see it, and then roll out a report.
So from start to finish, if I heard you right, about 3 to 4 weeks?
Correct.
Depending on the cooperation you get from the seller.
Absolutely. Yeah. And the information available. If we've walked into situations where we could tell the financials were not in a position to really be able to make good judgment on, which of course is going to be beat up in due diligence if anybody's going to acquire you. So we suggest to maybe go back to their accountants or maybe upgrade their accountants and other, members of their team to really present their story in a more acceptable fashion or more, gap, for instance, fashion if they're large enough. People want to make sure that comparability and the data is accurate. Mm-hmm. And again, you get into due diligence, if they start to, look at the underlying data and find holes in it or find, the process to generate those inputs are not consistent or maybe spread across the wrong team, they'll be able to probably pick and drill in on some aspects that could indicate a lower value and start to pressure that value equation.
That kind of leads me to my next question. We've been talking a lot about a valuation for a seller, but I know a lot of times a buyer wants to get his own valuation because he thinks the seller's valuation is too high. Have you been on both sides of the coin, and how does that work?
We have, yes. We advise buyers all the time as far as making an investment, because sometimes that buyer has a specific desire for that company. And it may be that the seller is selling one thing, but the buyer is buying a different thing. And it's interesting working with some of the private equity firms that really understand data and content, especially, 5-10 years ago. They saw a play out there that the owner really didn't see. So the owner was selling him this list of services and this capability, and they were looking at the data play on the back end. I have a great example of that where a company was purchased by a private equity. Within 6 months, they had sold the rights to the data for like 20% of the purchase price. So in one swoop, basically recovered 20% of their investment from something the owner didn't even know he really had.
Wow. Is there anything, Cary, that I did not ask about valuations that the audience should know? And again, I'm looking at the family-owned business, small business. Is there anything that I didn't ask?
No, something to realize is that the smaller the company, sometimes even the more difficult it is to value. To the extent that you have good data records and you have good understanding of your customer base and your cash flows, it really helps to enhance the conversation and allows us to do our job more efficiently and actually come up with a more robust and more supportable conclusion. So the extent that valuation is a dynamic area, the willing buyer, willing seller have many different views. It's what are you really trying to sell, and is that really what the market's buying today? Looking at those type of aspects are important every day.
So cash flow, risk, and growth. You've been talking about that quite a bit.
Yes.
That's the key.
Yes, absolutely. The extent you can increase cash flow, reduce risk, change that long-term growth perspective, you can really enhance the value of the company and move it up the right side of the value curve.
Well, that's all I have today. Thanks for being with us, Cary.
Thank you for the opportunity.
That's the episode of Wait, What on valuations. If you want to get hold of Cary Potter, please email me at eb@wait-what.biz. Thank you. Next week, we'll have David Greenberg returning guest, and he'll be discussing buy-sell agreements.